Tyco was founded in 1960 by Arthur J. Rosenberg. The company was formed as an investment and holding company to have two main segments: Tyco Semiconductors and the Materials Research Laboratory. After just 2 years, the business was incorporated in Massachusetts, and the primary focus became focused on high-tech material sciences. In 1964, the company went public. The company performed above expectations for the next 2 decades, with sales topping 125 million US. Most of their sales were generated from Simplex Technology, Grinnell Fire Protection Systems, Armin Plastic, and Ludlow Corporation. In the 80s, the company focused on more its newly acquired subsidiaries. The company was broken down into three business segments: fire protection, electronics, and packaging. The company heavily researched these three areas throughout the 80s.
In 1992, Dennis Kowalski made CEO of Tyco International, and throughout his control of the company, Tyco gained a very aggressive acquisition strategy to purchase over 1,000 other companies between 1991 and 2001. At this point, the company had so many employees, Tyco World, an internal employee newsletter, was created to send information to all the employees. In 1996, Tyco was among the top 500 publicly traded companies in the United States with regards to market capitalization. On July 1997, Tyco performed a reverse takeover with a significantly smaller, publicly traded company, ADT Limited. ADT then changed their name to Tyco International Limited and kept the same stock trading symbol as Tyco. This reverse takeover moved Tyco's main headquarters from Massachusetts to Bermuda. The reason for this was because Bermuda allowed the company to save millions of dollars in taxes. Tyco Limited purchased two other companies, also in the S&P 500, for a total of $3 billion. At the end of 2000, Tyco stock was trading at about 56 US dollars and had a net revenue of just under 29 billion. Tyco held about 270,000 employees and was the world's leader in undersea fiber optic cables.
Former Chief Executive and former Chief Financial Officer Mr. Dennis Kowalski took a total of $600 million through a racketeering scheme that took place through stock fraud, unauthorized bonuses, and falsified expense accounts. Kowalski's second-in-command, Mark Schwartz, used the company funds to pay for personal expenses, real estate, jewelry, and special employee bonuses. These personal expenses included a multi-million-dollar week-long 40th birthday party for his wife on the Italian island of Sardinia. The party became known as the Tyco Roman Orgy. Mark Belnick, the former general counsel, has also been thought to be involved in fraudulent activity. The three were charged with several counts of fraud, and all plead not guilty to the charges. During the proceedings, the prosecutor argued that Mark Kowalski and Mr. Schwartz stole a total of $170 million from the business while artificially inflating the value of the stock. The inflation of this stock caused the value of Tyco to drop 70% after the scandal was discovered. The members surrendered their passports under fear they would leave the country.
There was no true systematic accounting fraud made by Tyco or any of its employees. The money stolen from Tyco, taken by Mr. Kowalski and Mr. Schwartz, was taken in the form of interest-free loans through a key employee loan program the company offered. These loans were made out to Mr. Kowalski or Mr. Schwartz and were never approved by the rest of the board, but the two were able to bypass this because of their authority in the company. The loans were made to be paid on the maturity date, but were always forgiven just prior and wiped from the records. These loans were also given to any other high-ranking employee who would offer to cover up what the two have been doing and keep others' mouths shut. As many as 40 interest-free loans were signed off by either Mr. Kowalski or Mr. Schwartz. Some of these loans were buried in subordinates in unrelated expense accounts to hide the forgiven loans. The two had also inflated the stock value of the company by sending gifts ranging from luxurious hotel stays and to $1,000 watches. These gifts were given to any stock analysts who favored Tyco stock. The higher the stock analysts would value Tyco, the greater their gift would be. The two essentially paid stock analysts to highly value Tyco stock. While the inflated stock reached its peak value, the two involved sold off large parts of the company without telling other investors. This is a big requirement under SEC rules.
Mr. Kowalski and Mr. Schwartz used an accounting system by the name of spring-loading accounting. In spring-loading, the pre-acquisition earnings of an acquired company are underreported, giving the merged companies the appearance of an earning boost afterwards. The two were able to hide losses using the accounting method. The SEC launched an analysis of Tyco's books from 1999 to 2000. But the actions ended with the SEC deciding to take no action because they could not find evidence of fraudulent activity. Two factors sparked a second investigation into the company's records in 2002. Mr. Kowalski was a lover of fine art, and this love of art and greed led to the downfall of the company. A man who had all the money in the world refused to pay sales tax on $13 million in artwork purchased with the company funds. The work was moved to his New York home. Once it was discovered Kowalski failed to pay the required sales tax on his beloved artwork, another investigation took place. Through the start of the investigation, Mr. Kowalski and Mr. Schwartz immediately resigned for personal reasons and replaced by John Ford. By 2003, charges were filed against Kowalski, Schwartz, and Belnick for failure to disclose information that was required by the investigators. The money was asked to be returned, however, the three all pleaded not guilty and refused to have possession of any Tyco funds. The money was never returned until the three were convicted.
The court proceedings found Mr. Kowalski and Mr. Schwartz guilty in 2005. They were found guilty of taking $120 million without Tyco board approval, abusing employee loan programs, misrepresenting the company's financial health to investors, and selling stock without approval. Both are serving sentences from a minimum 8 years and 4 months to a maximum of 25 years. Mr. Belnick was convicted of just minor fraudulent charges and was fined $100,000 for his role in the scandal. After the extended investigation and convictions, Tyco has replaced all of its board members and several executive partners. Tyco has managed to bounce back from the major financial hit from the scandal. The company split up into 3 publicly traded companies in 2007. The 3 companies are doing very well to this date with all events prior. The company has boiled down into Covidin Limited, Tyco Electronics Limited, and Tyco International Limited. Tyco International today provides 5 main services, including ADT Worldwide, fire protection services, safety products, flow control, and electrical and metal products. The company made $18.8 billion in its first year after the separation and employed about 118,000 Americans.